Christopher Merrill. I'm the co-founder, chairman, and CEO of Harrison Street. We're a real assets firm that focuses on alternative real estate. From my seat, is from the investing side, is really thinking about portfolio construction, portfolio management, thinking about where you want to allocate assets across your portfolio. How much do you want to be in higher climate risk areas, and how do you manage that risk? Well, I mean, I think the reality is sort of hitting everyone in the face right now. Insurance premiums are up. So premiums have been up 20, 30% year over year. Number two, in a lot of coastal markets, carriers are pulling away. So in a lot of cases, you can't even get coverage. And so now it's a question of how do you manage that issue, but then how do you think long-term about assets that are in higher climate zones? Is there a valuation issue, and how should you think about it? And so there's a number of things that firms can do to think about risk management and how to really address those issues. Anytime you're making investment wherever it is in the country is really thinking about potential exposure to events, wildfires, wind, floods. So what is the physical elements of the building? And are you properly creating a facility that is going to be resilient? So thinking about the resilience of assets is one. Thinking about portfolio constructions, how much do you want to have your portfolio in some of these markets? If you have enough scale, we can explore creating our own insurance to protect some of those assets. So you're seeing a number of managers saying, hey, we can actually step in areas that the insurance companies are not going to cover because we've got data, we understand that, we've got a balance sheet, and we can try and fill that gap and fill that hole and add some sort of competition to the insurance companies. There's not going to be a firm that goes through an investment committee process that doesn't really think about what are the elements of risk associated with the physical construction of this asset, the location of this asset. So I think that's where managers just need to be really focused on these issues going forward. There hasn't been a real deep discussion of what happens if in 10, 15 years insurance is not available in any of these markets. The question is longer term, is there actually going to be an impact in valuation for assets in higher climate risk areas? And I think there has to be, because I think what capital is going to do is reduce their exposure to those markets. And again, that's going to reduce competition, going to reduce demand. So in some cases, I think there is going to be some premium, some pricing, some risk variable that's going to be needed to add to markets in these higher climate risk areas.